We're officially live on YouTube for the Thursday edition of the Not Your Average Investor Show. This is Ask Me Anything with GC Q3 Quarterly Market Jacksonville Update. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, our phenomenal community manager. We call her MTM because she brings us the moments that matter. And because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And we want to welcome the community. Good to have you back here after we had like 100.
I heard 160 folks popped in for at least a minute. I think we had 110, 120 folks that were there most of the time. Man, what a showing. Thank you guys for being there. I mean, man, that makes our day. Yeah, it's great. And we got people showing up for the recap right now. Welcome. If you are new to the community, maybe you saw the update last week, on Tuesday, and you're like, oh man, I want to learn more about rental properties. We got a class for you, GC. We do.
If you go to notyouraverage.com, GC and I put together a class that is called...
It's called the Not Your Average Investor's Guide to Investing in Rental Properties Passively. And it is a great class, whether you're a new investor. And listen, I remember how scary it was before I bought my first rental property. I remember that was 17 years ago, and I needed a helping hand to get me there. Luckily, I had mentorship to help me do that. And so if you're a new investor, that's what this class can represent for you. It's that mentorship. You get to kind of get inside the heads of myself and Pablo and everybody here at JWB who has invested in over 3,000 rental properties ourselves. And we manage over $800 million of real estate portfolio. So that's the class for you. You can go to notyouraverage.com, but don't just, think if you're an advanced investor, if you've got 3 properties, 5 properties, 10 properties, that you're not going to get something out of this class as well. We own over 300 properties here as our company here in Jacksonville. And we know what it takes to scale, to go from 3, 5, 10 to 20, 30, 50, 300. And so if you want to understand that, again, go to notyouraverage.com and join us in the class.
All right. Yeah. We spent a couple of months putting it together, and we did our best to whittle it down to 2 hours of densely packed information, all the questions that you need to ask if you are engaging with a rental property provider, all the answers you need to know if you're doing it yourself and the team you want to build around it. Really, really great foundation. I learned a lot doing it, and I laughed a bunch.
You did. That's unlike you.
It was a good time. It's a good time. It's a funny time. So anyways, go to notyouraverage.com, check that out. And once you do that, then you show up here and you're super comfortable, and you get to get part of what you see.
The roll call, baby.
We got Chris Lee from Fernandina Beach checking in first. We got the leadoff hitter batting second.
John Henning.
We got the MVP of the community.
Mr. Lee Bishop.
Mr. Lee Bishop batting third. We got our hermano from Granada.
Hermano de Granada.
Hermano de Granada.
Miguel Ángel, good to see you, buddy.
Good to have you, my friend. We got a man that checks in with a buenas tardes, amigos.
Nuestro otro amigo.
Hermano.
Mi clase de español son helping. Bill, great to see you, buddy.
Bill Shields in the house. We got Lita Song becoming a regular.
All right, Lita. Great to see you.
Good to have you from beautiful Minnesota. Love that. We got our regulars, the second family of the Not Your Average Investor Show, Gary and Rosalind Wrighty from Murrieta, California.
We regard you.
We got Big Papa in the house. We love it when he calls him Big Papa.
Pops, how are you? Good to see you, buddy.
Not gonna lie, since I was in New York, I was listening to a lot of Notorious B.I.G. on the plane up there just to get in the vibe. So
can I share a story about my family, by the way?
Please.
So I was sitting with my kids, helping them do homework, and I don't know why I was looking at the show or whatnot. And all of a sudden, my son and my daughter start looking, and it's happened to be when we're doing the roll call. And they look at me, and they just thought that me and you were from like another planet. My son is 9, my daughter's 11, and they looked at me and they were like, what are you doing? I don't understand. People are like watching you. You look like you guys are from another planet. So I'm glad you all enjoy the roll call. We have a blast with it. 9 and 11-year-olds, I don't know if they get it.
They'll mature into it.
Yeah. Especially when I was like, we call Grandpa Big Papa.
It's an acquired taste. We got Leo Farraganan.
Dun, 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 dun.
Farraganan.
Dun, 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 dun.
From the Bay Area. Let's rock. Good to have you, Leo Farraganan. We got the first family of the Not Your Average Investor Show, Ken and Carolyn Milleen, the patriarch and the matriarch. We salute you. We got the Oh,
Billy Green.
Green from the Sunshine Mountains of Colorado. Billy, good to have you in the house. We got the Shaman.
Nadeem Shah.
And he likes his nickname. It's official.
Oh,
I like
fantastic.
it. Nadeem, good to have you. We got Laura Colby in the house from Washington State. Laura, good to have you back.
Fantastic.
We got the touchdown maker.
Shannon Baker.
Shannon Baker, teammate in the house. We got Todd Johnson from
All right.
North Georgia. New name?
New name?
New name?
All
Todd,
right.
welcome.
Todd, welcome.
Good to have you. We got Pamela Myers back from Washington State. Pamela got
Fantastic. Pamela's a client for sure.
Yeah.
Great roll call, guys.
Marilyn Cotterman from Homosassa, Florida.
That's the home of the manatees, Pablo.
Home of the manatees. Layla Powell in the house.
All right,
Good to have
JWB
you,
team
Layla.
strong.
All right, we're gonna kick this. Oh, our favorite names to pronounce. Aaron O'Neill.
Into the lights.
Good to have you.
Kids
Aaron.
love that one, by the way.
That's the one that she likes. And our favorite fee-based fiduciary financial advisor,
Friend.
friend, Kelly
Kelly
Barenbaum in the house. Good to have you, Kelly. Love the roll call. You know what I like the most?
What's that?
My favorite moment of the week when Madison shares good news. What's the good news, Madison?
All right, everybody. So news broke that for the 12th consecutive year, JWB has been named as one of the fastest growing companies in America by Inc. 500. And I just think it's a super cool award. I know we've won it or been on the list for 12 years now, but being in the thick of it and seeing the growth every day, being a teammate here and just where we want to go and how we're building to get there is just super cool. So I think it's a really, really awesome acknowledgement to be on this list yet again. So
Me too. Me too.
Yeah.
12 years. Every year since 2011, we've been on the fastest growing companies list in our great country. Lots gone on in the last 12 years.
Yeah.
But one thing that hasn't changed is that our company has continued to grow. So huge credit to everybody who you don't see here at JWB, the 100 and some odd teammates here who work so hard, who care so much. So a big team victory and great news to share, Madison. Great job.
thank you.
We've talked about awards and stuff like that, man. How do you view these awards? Like, how much stock do you put into them? What's the value to JWB for winning this?
There are certain awards that really mean more to me than others. I'll be honest with you. Like the fastest growing companies award doesn't mean as much as other awards, just being candid. I'm super thankful and appreciative that we win the award. And it does represent an incredible amount of hard work and a big team victory. But there's an award that I think means more to us, and that is best places to work.
Yeah.
Best places to work for us means so much because it's a statement on our culture, right? We've been able to win that award 7 times now, and that's something really to be proud of. And what it also does is it helps us attract the next level of talent coming in who wants to work for a great culture and a team and a mission that they believe in. So that's probably the award that we care about the most.
That's the one you care about. Inc. 5000. The Inc. 500. Are you only one company in the Inc. 500, or are you guys like? I know that you receive multiple growth awards for multiple companies.
There have been a few years we've been on it for both companies, JWB Property Management and JWB Real Estate Capital. This year, just one, JWB Property Management.
Okay, well,
Only one.
you'll get there one day. Madison, you know what I call that, right?
Good news.
I call that good news. All right, let's do it. GC, quick summary. Just to remind you all, we had a hour and a half long call, JWB quarterly market update. Greg gave his outlook on everything. You can check that out on YouTube. It's live on the live that you can see it. We're going to post-produce it and release it again on Monday on our podcast and YouTube as well. But essentially the takeaways from the report. And I want you all, if you're here and you got more questions about it, please put them in the Q&A. We want to address them. We've got a whole list to address as well. Essentially the takeaways that I got from this report was we recapped the idea that the prediction last quarter that you kept hearing from everybody was this idea of there's a recession, there's a housing market crisis that looks imminent. We recapped the idea that last quarter we said that wasn't going to happen, right? Because of your predictions and based on the data and the perspective that you have. We showed that there has not been that. There has been just a regular seasonality, regular correction that happens at the beginning of the year in the housing market. And then we went into the current dynamics of the housing market, which showed there still to be a shortage of supply based on the demand that is out there for Jacksonville housing stock, buoyed by the supply is still, a lagging thing that has continued to happen, still haven't been able to cut up to it. This big immigration and all this stuff, the demand is still high. And the idea that it got exaggerated even more by the high interest rates. People in their homes are not wanting to sell their homes right now because they're locked into this like really nice mortgage payment that they're paying, and they don't feel like changing that, right? So that keeps houses off the market. Supply stays low. Demand is still consistently high because people are moving here, and people, there's a low supply there. And then we talked about the Jacksonville downtown statistics, which show this idea that we've talked about. When you cross 10,000 residents in a downtown area, the urban core takes on a whole flywheel life of their own. And once that happens, property values all around it go up at a faster rate than it was before. It bends the curve over. And what we have seen is a downtown that has been consistently growing faster and faster. We now see this 10,000 resident number to be crossed within a year. And what we're seeing is that the level of investment into downtown and projects underway have gone way, way up in a short amount of time. So that is essentially the takeaways. Did I miss anything there?
You did a great job. I'll throw in a few things. What has been making most of the noise in the headlines over the last year has been interest rates and lack of home sales. And people have been misinterpreting that to think that home prices have been going down, and then really misinterpreting that to think that home prices are going to crash. But in any market, there's supply and there's demand. And when we're talking about interest rates and we're talking about home sales, those are demand side factors. Up until just recently, nobody other than us here in the community was talking about the supply side. So while the rest of the country might be surprised that home prices are still high and home prices have actually gone up in markets like Jacksonville, we're not surprised. It's because the supply is so low that even though interest rates have been higher than we all want, and that has tamped down demand a little bit, you can't solve the supply problem overnight. And so that's why your assets have continued to maintain their high floor of pricing. And that's why they're still going to maintain their high floor of pricing. And there's going to be upward pressure over the next, call it 3 years or however long we want to look out. It's because this supply problem, we call it a problem. It is a good thing to be owning assets when there's a supply problem. And so that supply shortage is not going to be fixed overnight. And that's why, acquiring these assets right now puts you in the driver's seat to see increased home prices and increased rents in the foreseeable future.
Great addition to that, man. I like that a lot. All right. So let's jump right into the questions. We have, first one is Juan Duque showed up and asked a bunch of great questions. So
man, I think he wins the award for the best questions.
He gets the most questions.
Yeah.
Maybe in the near future, we're going to have some kind of giveaway or something like that for awards.
I don't know. Are you looking at something over here that we're thinking about potentially throwing into giveaway status here sometime soon?
I'm not going to lie. There was KJ walked in here with there's like 5 boxes of JWB swag that we're going to implement into a giveaway program here. So stay tuned for the Not Your Average.
That'll keep them showing up.
Yeah, that'll keep them showing up. That's about to happen. We don't have it all figured out yet. We just got the stuff. Now we just got to figure out how to get it to you, but stay tuned. So anyways, Juan Duque, future award winner, asked, the first question he asked was, good afternoon. Could you talk about immigration figures that are boosting the Jacksonville market and maybe compare them to other cities in Florida?
Yeah, I can do a little bit of what Juan's asking here. I don't have all the data at the ready here, but, immigration into Jacksonville has been a major story even before the pandemic. If you go back to the last data per MSA that the census released was from 2017 through 2019. If you looked at that data, Jacksonville was the 5th fastest growing MSA in the country, and that was pre-pandemic. Ever since the pandemic, all we have heard is that there has been a huge amount of in-migration, and Jacksonville is one of the most popular cities. We see it as we live locally here. It's been a huge explosion of population here. So it was 3.6% population growth from 2017 to 2019. Just to put it in perspective, the overall country grew 1%.
Oh, wow. Okay.
Yeah. And then my favorite city to compare Jacksonville to is Cleveland. Cleveland was down 0.4% for population growth. So yes, there is a tremendous amount of immigration, of population growth here in Jacksonville. And that is driving home price demand. I don't have other cities in Florida off the top of my head. I think we did a slide on Miami. Or I don't know if we put Miami in the slide, or Tampa. I think we did. I don't know. I don't have other cities at the ready, but everything in the Southeast has seen huge population growth. So I wouldn't be surprised if those cities also were pretty high.
Yeah. And to add a little perspective, right? You're able to use census numbers that are like 2 years old, right? Something like that.
Mm-hmm.
So that's why we're talking about pre-COVID. We don't really know the numbers post-COVID because it hasn't matured yet.
They have a whole bunch of census data that's been released, but it's not per MSA.
Mm-hmm.
And so I'm waiting for that to get the updated numbers. But, every other, data source that you're looking at, whether that is some census data that's showing that, states like Florida are seeing huge population growth, or even like moves by U-Haul, or like LinkedIn, profiles that are changing from, Sheboygan to Jacksonville as a hometown. Like all of those things are leading towards Jacksonville's population growth. And that's a great thing for all of us, right? That is demand for housing, both on the rent and the sale side.
Yeah, totally. And just to kind of like put a exclamation point on that, right? Like me, as somebody that has had Jacksonville on my radar, living down in Miami for a while, like I would just see list after list of Jacksonville being this like fastest growing city in America, like most livable, one of the most livable cities in America, most affordable cities in America, right? Like these lists that Jacksonville has been on that have been driving this immigration has been happening at least as far back as like 2014 that it was on my radar. And it feels like anecdotally, we don't have the census stuff and these different things, but it does feel anecdotally like that's greatly accelerated. Like when the people that I hang out with, I would say, as I meet more and more people, the amount of people that got here post 2020 is a high percentage of those folks that you're meeting out there, right? So like it feels like the numbers that we're going to see are probably higher than they were before, would be my guess. You
want to know something? I just realized I used to have to really evangelize the city of Jacksonville a lot when we're attracting new investors. When I remember 2006, 2008, 2010, 2012, even 2014, I don't know when it shifted, but nobody thought about investing in Jacksonville. I had to really show people what Jacksonville could do. I remember knowing that was a big part of my marketing strategies is evangelizing Jacksonville. I don't have to do that anymore. Yeah. You're right about all these lists and about all of this. People come to us all the time that they know they want to be in the Jacksonville market. They're just not sure exactly how to do it, which is a big shift. It wasn't always that way. And, the cat's out of the bag.
When did evangelizing Jacksonville land on you that you had to be doing that? Was that always?
Honestly, I just thought about it right now. Like, what are you talking about? What you told me to do when we started working together? Yeah. I should know. Every leading question goes back to making sure I told Pablo how awesome he is.
That's right. All right, cool. So we had a lot of questions. We talked a lot about how prices are going to go up, right? So within this, Robert Solomon asked, how are rental prices affected, right? How are rents being affected by this upward momentum on housing prices, GC?
Yeah, so rents are still strong, rents are still consistent, right? You'll read some articles out across the country, and rents are going down in some markets, but not generally in the Southeast. In Jacksonville, our rents are strong. In fact, we continue to see average normal rent growth year over year. It's not the 10% rent growth that we saw last year and the year before, which makes some people think, oh goodness, rents are in trouble. But no, we're still expecting to see, call it 3.5% rent growth this year, and actually roughly about that and slightly more as we look into next year and the following year. So rents are still strong. Rents are still consistent. They're not growing at the same pace that they were before because that's unsustainable. Yep. And yeah, so that's what rents are doing.
We expect rents to grow over time. We just want them to grow in commiseration with average incomes, right? And people being able to afford it. So it doesn't turn into like a crisis out here. It's already based on the TEDx event that I went to, where Alex, your partner, was speaking out on Monday about downtown Jacksonville. It seems like the locals feel like they're feeling a pinch on rent appreciation.
Absolutely.
Right? Like they're definitely feeling that rents have gone up, rents continue to go up. The idea is that what you are doing in downtown and what Shad Khan is doing in downtown and what this coalition of people are doing in downtown is investing in an urban center that will increase average incomes in order to support fast growing rents, right? So
exactly. A lot of folks are talking about home price affordability, and I'm sensitive to that as well, right? Rents and prices have gone way up. But again, that's only looking at one side of the equation, right? If we can raise median incomes, rents can still be as high as they are right now, and then they become more affordable.
Yeah.
Right. You don't have to drop rents or drop prices to become affordable. You can raise median incomes. Downtown Jacksonville represents the greatest opportunity for us to have a significant impact in raising median incomes. And so that's one of the reasons why we're so excited to put our money downtown and be a part of the solution there.
awesome. I'm going to jump ahead to somebody who's here live, Todd Johnson, our new friend. Todd, I hope you make a habit out of hanging out here.
All right.
On the Not Your Average Investor Show. He's asking, insurance has been a hot topic in Florida. How do you see insurance renewals affecting cash flow and overall returns for investors over the next several years?
Great question, Todd. I'm going to take it from the perspective of somebody that purchased homes, call it a couple of years ago, or maybe 5 years ago, somewhere around there. And how are they going to be affected going forward? So if you think about how you made those purchases a few years ago or whatnot, you had a certain expectation for what your rents were going to be, and you had a certain expectation for what your insurance costs were going to be. And then you boil all that down with a bunch of other stuff, and you comes to what your return on investment would be.
You also had an expectation on home price appreciation.
Home price appreciation, right? Yeah. Well, what you have seen, like in your job as an investor, to take all those inputs and see how it matriculated down the field, right? How did you net out of this? And it's not always going to be exactly like the evaluation. Well, so if you bought a few years ago, the rent that you expected on your evaluation was this, and this is what you got. You got a significantly higher rent rate and rent rate growth than you were expecting if you're a JWB client, and probably even if you weren't, right? So you're winning way there. Home prices have been up 50% in the last 3 years, right? Your investment is absolutely doing so much better because of home price appreciation. And then on the downside, right? Insurance rates have gone up much higher than we expected as well. Couldn't have foreseen that the lawyers, the legal loopholes, and the insurance companies, were going to get sued like they were, and all that challenge. But, at the end of the day, I think Todd's question is more about cash flow. You're winning with the rents that have gone up. Even if you take the increase in the insurance costs into account, you're still winning on a cash flow basis. And then if you sprinkle on the 50% of home price appreciation, which you weren't expecting when you bought, you are really winning. So I think going forward, for those clients who have seen increases in insurance costs, when I look at their overall portfolio, expected returns versus actuals, they're better than they were expecting. And I feel really good about that happening going forward. As well, we do expect that the insurance problem, the biggest problems are behind us. Doesn't mean that we still don't have problems, but the biggest problems are behind us. The state legislature has stepped in and solved what we hear to be 70 to 80% of the, call it, problems that we saw with the industry and the number of lawsuits that were driving insurance companies out. So I do expect that to get better in the coming years as well, which will just increase returns for those clients that have purchased.
So what I'm hearing from you is, first of all, Todd, we did a whole show on insurance about a month or two ago. If you look back in the back catalog of the podcast or the YouTube channel, whichever way you like to consume content, you're going to see like a big insurance update from me and Whitney Ritchie talking about everything that happened behind the scenes and what the future looks like, right? So first thing I'm hearing from you is summary from that update. Our problems are, the big pain point has been solved for, and going forward, things will start to get easier and be relieved from the thing that was causing this whole thing, which was this like legal loophole that was happening.
I did want to add one more thing too. I didn't address those who are buying today.
I was going to ask you that in a follow-up. Let me just summarize what you just said. If you've been in for existing investors, the increase in rents and increase in home price appreciation have outpaced the unforeseen increases in insurance costs, is essentially what you said.
100%.
Right. So people are still doing better than they thought, regardless of the unforeseen increase in insurance costs has been more than made up for by the increase in appreciation and increasing cash flow for those of us that were already in. Now, what about for somebody looking forward, looking at buying today? What does that outlook look like with insurance?
Now it's a great outlook for you to buy today too, because we know what insurance rates are today. We have these insurance quotes prepared before we put the portfolio together for you. So that's not the same way in every way that you buy a rental property, by the way. Many insurance quotes are just generalized and not to that specific property you're buying. So just word to the wise out there, if you're buying rental properties, make sure you get an actual quote on your property before you put it under contract so you don't get burned there. But for JWB clients, we've done that forever. And the insurance rates are really well known now. There was a period where they were going up faster than we were expecting. Nobody knew why. And now, of course, that's all figured itself out. Now, if you're buying, you're in a really great spot. We have that quoted for you ahead of time. You can walk into this investment with confidence, knowing that we have expected a larger insurance cost because that's what the rates are right now. And you're still cash flow positive and you're still, earning, call it a 9-10% return on investment every single year. So you're in a great spot there too.
Awesome. Great. I was going to add something to that and I forgot what it was. Oh yeah. That was a big takeaway in the class, the notyouraverage.com, right? On the insurance side, we talk about all the different cash flow killers inside the class and how to prevent it on day one and how to avoid them going forward and the things that you got to know getting in. One of them is that when it comes to insurance, when you are investing in a rental property, insurance is one of the numbers that you should have it in writing, knowing exactly what it's going to be. No surprises on day one, because it should be there. Not an estimate, not a we believe it's this or that. You should already have a quote with the person that's bringing you forward this deal, and that number should be locked in, at least for the short term.
100%.
Yeah, cool. Miguel Angel, who's here, so we're going to do it. He asked straight up, are prices growing faster than rents? Since we were just talking about how prices and rents are corresponding.
Yes.
Yes. So home price appreciation is outpacing rent prices.
I'm talking about the last 3 years, 100%. Yes. This year, it's probably pretty close. So, they're both up a little bit.
And what does that mean to an investor? Like, what should I infer into that?
Big picture, in many markets out there, it is getting increasingly hard to produce positive cash flow because as home prices go up and up and up, and rents generally don't keep pace with prices, it gets harder to produce positive cash flow. So some borderline cash flow markets out there are no longer cash flow markets. Luckily, Jacksonville is an affordable market. So even though home prices have gone up and rents have gone up, but not as much, we're still able to produce positive cash flow for these portfolios that we put together for clients. What you'll see is instead of producing positive cash flow at 20% down, like may have been possible in the past, now you got to put 25% down. And sometimes it's 30% down. So positive cash flow is not hard to achieve in our market, but as home prices continue to outpace rents, it will get increasingly difficult. We'll see what rents and home prices do over the next few years. I just don't see them outpacing. I don't see prices outpacing rents at the same rate that they used to.
Yep.
So in essence, the divide should not be as wide, in the future as it has been for the last 3 years.
So as an investor, when I hear you say that, I'm essentially hearing, okay, then the sooner I can get in, the better, right? Like if I'm able to like pull forward some demand to get some properties right now, right? Like if I want to look at my other asset classes, if I know that I'm going to be investing in rental properties as part of my retirement, as part of my long-term wealth creation strategy, then I want to get in as soon as I can before the prices continue to rise and decrease 100%. The cash flows, right?
And think beyond the interest rate today. If you were locked into this interest rate for the next 30 years, I might say, we might have to consider that. Guys, it is as easy as refinancing your interest rate. If you don't like the interest rate today, even though you still get positive cash flow, if you don't like it today, buy the house. And then when rates come down in the future, as everybody expects, just refinance. And then the positive cash flow that you're making today with the high interest rate is just more when you refinance in 1, 2, 3 years, whatever it is. So, look beyond the interest rate that you feel is high today and make a great decision because the underlying asset value is going up.
Yeah. So if that's something that people are interested, I feel like as an investor, I would think, okay, yeah, but what if I don't have it right now? What I've learned recently is that your first call with JWB, if you go to chatwithjwb.com, is a lot about exploring. There's different places that people are pulling from in order to get into this asset class these days that most people they think they know about it, but there's much more than you think. So chatwithjwb.com, if you want to get that conversation started, look for extra source of capital in order to get in before prices continue to outpace rent. The other thing that I think about when you tell me that prices are outpacing rent, GC, where my head went was okay, if prices are outpacing rent, that means that it's going to be harder for the person that's a renter to buy a home later on. And therefore, for me as an investor, I think that's risk mitigation for me, because it's going to continue to provide a nice supply of renters into the market that I am investing in as well.
100%. It's one of the reasons I love this asset class so much. There are so many ways to win in this asset class. You are not just banking on one strategy, right? Unfortunately, home price affordability is an issue for our entire country. When home prices become unaffordable, it takes a certain segment of the population that otherwise would have purchased a home and it turns them into renters. Now, I'm not saying that I want that for our country, but what I'm saying is I want to own the asset that can solve that problem when that issue is there. And I also want to work to solve the big problem of home price affordability, which largely comes down to easier and better building regulations and less red tape. So anyways, it's good to own the asset in an environment like we are today. And that's why I just think putting these assets in your portfolio right now is a really great idea.
Yeah. And again, for ideas on how you can make that happen, chat with jwb.com, set up a call. It's a good time. All right, let's go back to our Q&A. GC, what do you think?
Love it.
Here is a question this is from Miguel Angel on Tuesday.
Fantastic.
He says, don't you see a top in house pricing when affordability becomes impossible?
Do I see a top in house pricing? I think we answered this one on the call last time too. We'll answer it again. I think
What's going on?
It might be the same answer. So no, I mean, technically, yes, in theory, could there be a top out of house pricing when home price affordability becomes impossible? Yes, in theory, that could happen, but it's not going to happen, right? So home prices going up is one side of the equation, but median incomes rising is another side of the equation. And so what generally would happen is if median incomes did not rise and home prices became more unaffordable, then at some point you would see lessening demand and you would see lower home price appreciation for that. You would never see it just top out. You never see people just stop buying houses. So you would see in a worst case scenario here, if we didn't solve, the affordability crisis, you would see lower home price appreciation in the future. But let me just poke a hole in that right now, guys. The reason why home prices are so unaffordable is because of interest rates and rising home prices. They just rose interest rates the fastest they've ever risen them in the last 40 years. And we're at, they rose at 5 percentage points, right? In a year and a half. So, everybody knows that at some point those interest rates are going to come down, at which point, home price affordability will get a huge bump, a good bump. It will become more affordable when interest rates come down. So that will happen. I am not concerned about home price affordability, hampering our ability to deliver the expected home price appreciation because of that reason. And because we have this thing called downtown, and it's been proven in city after city after city, the greatest catalyst to higher home price appreciation and affordability at the same time is a downtown that comes online as revitalized. And that's what we have here in Jacksonville.
Yeah, I remember answering this question on Tuesday. And I remember also adding in this idea that, right now, JWB is doing it the right way. They're betting on increasing median incomes, revitalizing downtown, making all that stuff pop. For me, as somebody that moved here 5 years ago, it's very clear that even if we tap out the home price affordability that the local market can pay, there is still going to be outside investors, outside people moving to Jacksonville with money that's been made outside of Jacksonville, coming here thinking, oh, wow, in Miami, this thing is a $1 million house and here I can get it for $500,000. I'm in.
Yeah.
Right.
That's a really good point.
That's going to continue to happen in an underpriced market that has a very stable economy. We're living in a place where you can work from anywhere these days anyways, in a lot of scenarios, great weather, no tax, no state income tax, right? That's going to continue to bring people to Jacksonville that have wealth from outside of Jacksonville. That's going to continue to go up. And I feel like that whole, are we at the top of the market in these places that people want to live and people have shown that want to continue to move to because they're getting better deals and have better lifestyle than these other markets that they were from? That whole, are we at the top of the market trope feels like just that, a trope, right?
Yeah.
It feels like one of these questions that for whatever reason, human nature can't help but keep on asking. And yet, if you've been in these things for a long time and been looking at real estate for a long time, it just never happens.
Yeah. I've heard we're at the top of the market every year for the last 15 years
Yeah.
of investing in Jacksonville. So
Yeah. Got it. Deal. So no. So the answer is no. We don't think we're going to reach that. Okay. Juan Duque had another great question. Do you happen to have the MOI data that differentiates class A, B, and C type properties? MOI, months of inventory, shake your thing around, make a noise. Yeah.
glad you asked, Juan.
So GC, we talk about MOI all the time. Juan asked for this. But what is the MOI right now?
Months of inventory is 2.9 here in Jacksonville overall.
Okay. Which means that normally historical months of inventory is 4.
Is 6 to 7.
It's 6 to 7, which if it is between 6 to 7, then then that means that you are at the historical appreciation rate, which is 4.6, and having something that's 2.9, having a lower than historical average months of inventory means that we should expect higher than average home price appreciation. Now, Juan also wants you to dive into some of the class.
Let me caveat you there,
Mhm.
because this is not a normal market. So yes, in a normal market, if it's just call it, there aren't as many variables. Yes, it's pretty easy to say you would expect to see higher than normal home price appreciation when you're below 6, and 2.9 is way below 6.
Mhm.
Like that's very rare that we've ever been that low, but that's why you need to keep tuning into this show, because there are other variables at play. So I will caution it a little bit here, right? I don't exactly know what the Fed's going to do, but the Fed does have the power to really dampen demand
Mhm.
by raising interest rates. And so, but what this should communicate to you, 2.9 versus 6 means no crash. That's what you should be taking from this. Whether that means higher than 4.6% home price appreciation, I'm not sure. We're going to figure it out together.
Okay.
But the question of, do we break it down by neighborhood type, A, B, C, D? We actually do that. I just haven't really shared it with you, but we do it every single month. So I thought that was a really cool leading question there, Juan. So I have it broken down here. So A neighborhoods, which would be, call it the nicest neighborhoods that you can think of in Jacksonville,
Mhm.
they have 2.8 months of inventory. B neighborhoods, a step down above middle income, but not high income neighborhoods, 2.5 months of inventory. C neighborhoods, workforce housing neighborhoods, where we focus, 2.8 months of inventory. And then D neighborhoods, low income neighborhoods, 4.4 months of inventory.
Interesting.
So A, B's, and C's are right around the same. D's have higher months of inventory, which is not unusual.
What do you take from that data, GC? What should we infer from that?
Not much. I mean, if there were huge swings, going from 3 to 4, going from rounded 3 to rounded 4 to going from A to D or whatnot, that's not really significant to me. If it was 10 versus 3, then I'd say, all right, something's going on here. Let's talk a lot about why this is happening. But this is pretty normal, right? So no, there's really not a whole lot of information to be gained by breaking it down, as far as helping you make better decisions. Inventory is low everywhere. That's the main theme here.
Got it. Couple easy ones for you to answer. What is the current median sales price for homes in and around Jacksonville?
360 or so.
360 or so is median sales price,
Mhm.
which means that JWB inventory should be somewhere around where?
About 180 to about 280 is our purchase prices.
Okay. And how do you do that? Do you multiply 360 by a certain percentage because you know that that's what the workforce housing range is, or are you just thinking about?
I just know what our inventory is.
It's my company, so I know what I'm doing.
I should probably know what our inventory is priced at. So no, it's not like based on what the market is doing, and then we go down. I look at our inventory. I see what our salespeople are placing in the assets in the portfolios. So that's how you do that.
Got it. Okay, we got an interesting question here, also from Juan Duque. How has your multifamily incursion been compared to what has typically been your core single family houses?
I saw this. I don't know what incursion means.
I was going to ask you. I was hoping that you would know.
Can the audience help me out with what incursion means? I'll answer it to the best of my abilities, but I forgot.
Means an invasion or attack, especially a sudden or brief one. Incursions on enemy territory. I would say it's like, how has your growth into multifamily? I don't know. I guess.
I don't know if they're talking about JWB specific or Jacksonville. I'm going to assume JWB specific. So JWB has not had an incursion into multifamily. All right. We have a few. We have talked about some of our downtown projects. We have 24 units as a part of our 218 Church Street project, which is one of the first ones that we renovated downtown. A wonderful, beautiful building. So we're talking about that one. There's a few others that we have, but our calling card has been single family rental properties here in workforce housing neighborhoods in Jacksonville. That's the majority of our holdings as a company. And that's what we put in portfolios for all of you. So there really hasn't been a change to that. Sometimes we get more and more headlines because of the downtown activity that we do, and it creates a perception that, is not real. I mean, our calling card, our hedgehog is turnkey single family rental properties because we think that's the best risk adjusted return for all of you out there.
Let's try to attack it from another perspective just to get more info into the answer.
Okay.
Let's say that what Juan is saying is, what has your experience been in developing these downtown properties and what returns you're expecting from them versus your typical single family home?
It's a completely different ball game. I mean, you could make more of a parallel to call it regular multifamily investing to single family investing, but you really can't even compare what we are doing downtown for some of these projects to our regular single family. And that's why I don't bring it to you as an investment opportunity. What we're investing in downtown, we put $68 million of our money into downtown properties. We own roughly 20 city blocks in the north core of Jacksonville. It's about 12% of all of the North Bank of downtown Jacksonville. And we are, I was about to say taking down. We are renovating and rehabilitating buildings that have been vacant for 30 years, 40 years. And they have forests growing inside of them.
There, yeah, the Jumanji building.
And these are just huge buildings as well, right? 12-story buildings, 7-story buildings. And I just can't even explain the level of scope of project here and the level of variables. And why are we doing it? Our expected return for the project that I was just speaking of, the 218 Church Street project, 2% in the first year. 2% is what we expected. Now, why would we, when I can make investments for you and sell them to you and have you earn, call it 9% or 10%, why would we take our own money and take on an incredible amount of risk, right? $20 million renovation here to earn a 2% return? Well, it's because we believe in the city. We want to be a part of the solution. We want to be a pioneer for downtown. We know what this can do for our great city. And then we have a responsibility to take advantage of opportunities for you all, right? You all own over 3,000 properties in workforce housing neighborhoods right around downtown, just like I do. I own over 300 of them. I'm right beside you. So I also have an incentive as a client as well. So those are the reasons why we are doing this. And we get the question a lot. Hey, I love downtown. I want to be a part of it. Can you make a recommendation on a type of building or asset to buy in downtown? And my answer is no, unless your risk profile is way different.
Yeah.
If you are here for single family, turnkey, passive, risk mitigated investments, I'm not telling you to go downtown. Don't do what I'm doing downtown. Get the benefit of what I'm doing downtown by investing in risk mitigated assets, which are single family homes around downtown.
And to do that, you go to chatwithjwb.com, set up a call, get up in that.
Thank you.
If I was just summarize what you said in a very, very short amount of time, it sounds like the way that your investments in downtown compare to your investment in single family home is that they are much harder and much riskier, and it takes a much more sophisticated investor with a longer outlook. So what you're saying is single family homes, perfect kind of like seat at the table. The stuff that you guys are doing downtown is a much more advanced game for later on.
There's a reason that I'm not accepting outside money. I'm not accepting your money to do that. It's because it's a way different risk profile and, doesn't suit the needs of our clientele.
Cool. Leo Ferguson says, is JWB still buying down interest rates?
Leo, great question. Yes, we are still buying down interest rates. We're doing this to help you get lower interest rates. That's how we get to 6% interest rates on our evaluations. And that's what we build our portfolios based off of. And that means that JWB is contributing thousands of dollars on every purchase so that we can buy those rates down for you.
Beautiful. Last question by Juan Duque. Again, the MVP of last week's call. Lee, don't get nervous. He says, so you had mentioned that right now, people are getting about 10% IRRs, right?
Yes.
He asked, what is typically the proportion between cash flow and appreciation from that 10% IRRs that we talked about on the show?
Great question, Juan. And I hope you continue to keep showing up here because this is a theme that we talk a lot about on our Thursday shows when we go through the portfolio of the week. If you break down how that 10% IRR is calculated and you see 20 years, 10 years, even 5 years after you purchased the home, how did you get to this big pile of returns? 60 to 80% of your returns come from home price appreciation. And that's why choosing the right market and choosing the right team to put you in the right neighborhood in the right market is so critical. That will be the largest contributor to your return on investment. You also asked about cash flow. Cash flow makes, that's usually the first question that we get asked. What's the cash flows? What are the cash flows? Cash flows. At the end of the day, guys, cash flows are going to make up less than 10% of your total pie when you hold on to this asset for a full market cycle. So what I would do is spend the majority of your time focusing on the team, first of all, and then follow the pie. If 60 to 80% of the pie is done by the right market and the right neighborhood, make sure you find the right market and find the right team so they put you in the right neighborhood. And cash flows are nice. They keep you in the game, but that's not how you're going to win in this asset class, especially compared to your other investment alternatives.
A couple of things I'm just going to hit on. Big takeaway from the class, right?
Yeah.
Like, I mean, that is the giant moral of the story, that if you want to learn exactly why we say this, but here's the big takeaway. Most people, when they invest in rental income properties, they spend a whole bunch of their time looking for a property. And, it's like, I said, this property, is that property? Does this one look good? Does this one not? Blah, 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 blah. Then once they get that property, they're just like, oh, okay, cool. Well, I got that property because I just de facto I'm looking in my own hometown. And now let me go look at Craigslist for who the property manager is. And that is the wrong way to do it, right? Because
I would think most of them go to Google. Do you think they go to Craigslist to find the property manager?
Maybe they go to Google, maybe they ask around a little bit once they find the property, right? That's the wrong way to do it. If you look at where your return comes from in rental property investing, it comes from being in it for a long time and home price appreciation, right? So to be in it for a long time, you have to have a really good experience in order to get all these returns from it. So what we teach you in this class is that your priority should be to look for, where is there a team that can handle this for me, that's going to assure me a good experience for a long time? Because you buy the property once, you own it for 30 years, right? So that's one. Once you figure that out, then you look for the markets. Then you where the teams are. Now, in what markets are these teams and what market fits my plan the best? If you are looking to grow, you want to be in a growth market. If you're looking for cash flow today, maybe a cash flow market is the place to be. But that's how you filter it out. And then once you do that, picking the property is super easy, as opposed to spending all your time on the wrong thing.
There you go.
Right. So that's one. And the other thing is, we talk about cash flow being 10% of the equation when you first get started and whatnot, right? And not being that significant. But the beauty of this asset class is that you grow a cash flow growth portfolio. Your cash flow grows over time. Most people buying this aren't looking for the cash flow today. And if you are, there's ways to make that happen. But the beauty of it is that no matter what, it continues to grow over time, so that by the time you get to your retirement years, most people right now are just trying to get a whole pile of equity and then live off that cash flow later on. But that forces them to be very risk averse once that happens, and you're kind of stuck. And if the market hits a slump, you're in trouble, right? In this asset class, your cash flow grows over time. So it's not about what your cash flow is today, how your cash flow grows over time by the time you're in retirement, and how it continues to grow when you're in retirement is the reason we talk about all that, right?
Love it, man.
Okay, cool. Last question by Miguel Angel. Are you still in the same neighborhoods as the past?
Absolutely.
Yep, still doing it. They still working.
Still working.
GC, good Q&A episode,
This is
AMA,
awesome.
further dive into this. Instead of going 2.5 hours for every market update, I think we're going to continue to do this.
I love this. It's great. Thank you, guys.
I do like this. This was good stuff. On Monday, we're back to Not Your Average Market Insights. Not Your Average.
On Monday?
On Tuesday.
Are you showing up on Monday?
I do show up on Monday.
Okay.
I play all day.
Every day. You're just constantly in the studio Monday at 12:30, waiting for people to show up.
This is what I do. This is what I do. On Tuesday, Not Your Average Insights. We're talking about, right? There's been a lot of headlines about recession. Now the headlines are soft landing.
Whoa.
We got soft landing.
Hey, it's all hunky dory.
What does it mean? What does this mean? We're going to dive into it, not your average insight style. Me and GC are going to pull apart some headlines, contextualize it for you, take your questions on it, and we hope to see you there. We really want to thank the community. We know that you had 160 people here on Tuesday, and then here we had about 50 people show up for the recap of this thing. So never goes unnoticed that you're spending 2 hours of your week with us here on a Tuesday, on a Thursday, middle of your workday. Just very, very grateful the community adds such great questions, makes our job easy and makes it fun.
Tell you what, it can get lonely up here if we don't get questions from you guys. We sincerely appreciate it. Thank you to some of the newer folks showing up here in the call and asking questions. I know that can be a little scary. So Juan, Todd, Miguel Angel, of course, has been a regular for many years now. We appreciate you guys and everybody here in the chat. I mean, this is such a fun, wonderful community to be a part of. So thank you guys. Looking forward to Tuesday's show where we get to riff a little bit on the economy.
It's going to be great. Hope to see you Tuesday. But until then, what's the advice, GC?
Don't be average.